There are 7 different types of investors and traders. By the end of this video, you'll find out which one you are, so that you can hopefully make more money with your current strategy. These range from people who invest in things like real estate, cryptocurrencies, stocks, bonds, and even day trading. Welcome to Chunghua Investments, where we break down everything that matters. Stocks that actually move the needle, leveraged ETFs that aren't just hype, and portfolio tactics that build wealth while others are busy guessing. We are not giving out financial advice, so please do your research and consult a financial advisor when making any investment decisions. Our goal is to help you make informed decisions so that you become a better investor. Let's start off with number 1, the trader. The trader is someone who likes to buy and sell securities on a regular basis, profiting from short to medium-term price movements. A trader's time horizon is measured in minutes, hours, days, or up to a few months. They look at charts, read real-time market data, and rely on technical analysis to spot potential price movements. Traders do and typically focus on a company's long-term fundamentals, instead focusing on short-term price action and market timing. This approach can be exciting and potentially very profitable, but it also comes with a medium to high level of risk, depending on their strategy and overall discipline. There are various types of traders, each with their own approach, such as day traders, who buy and sell within a single day, swing traders, who hold positions for several days to weeks, and momentum traders who capitalize on price trends. Regardless of the specific approach, trading generally involves active monitoring of markets, quick decision-making, and the ability to handle both profits and losses. It's important to note that successful trading often requires significant experience, skill, and knowledge. Number 2, the investor. An investor is someone who buys assets primarily for long-term growth, or income based on the belief that these assets will appreciate in value over time. They hold their investments for years or even decades. Investors typically prioritize the long-term prospects of a company or asset over short-term price fluctuations. They analyze fundamental factors like a company's earnings growth, dividends, and overall financial health rather than relying solely on technical indicators. Their goal is to build wealth gradually over time through the power of compounding and the growth of their investments. This approach is suitable for individuals who have a long time horizon, a high tolerance for risk, and a willingness to embrace the ups and downs of the market. Overall, investors play a crucial role in the financial markets, as they provide the capital necessary for businesses and projects to grow and thrive. Number 3, the swing trader. Swing trading is a strategy employed by traders who aim to capitalize on short to medium-term price swings in the market. Like day traders who close their positions daily, swing traders may hold their positions for several days to weeks. They analyze charts, identify potential support and resistance levels, and look for favorable market conditions to enter and exit trades. Swing traders rely on technical analysis and chart patterns to make informed decisions and often consider economic news and events that could impact price movements. While swing trading can potentially generate profits, it's essential to have a well-defined strategy, practice proper risk management, and continuously adapt to changing market conditions. At number 4, the day trader. Day trading involves buying and selling financial instruments within the same trading day, ensuring that all positions are closed before the market closes. Day traders analyze intraday charts, monitor real-time price movements, and make quick decisions based on short-term market fluctuations. They utilize various technical indicators and trading strategies to identify potential trading opportunities and capitalize on short-term price action. Day trading can be lucrative, but it's also high risk and requires strict discipline, effective risk management, and a tolerance for high-intensity trading. Number 5, buy and hold. Buy and hold is an investment strategy that involves purchasing a diversified portfolio of assets and holding them for the long term. This approach emphasizes patience, discipline, and a belief in the power of compounding over time. Buy and hold investors typically avoid making frequent trades or reacting to short-term market volatility. Instead, they focus on selecting quality assets that have the potential for long-term growth and value appreciation. This strategy is suitable for individuals who have a long time horizon, low to medium risk tolerance, and a desire for long-term wealth accumulation. Buy and hold investors often utilize index funds, or ETFs, to gain exposure to a wide range of assets, which helps mitigate risk and optimize diversification. And number 6, the speculator. A speculator is someone who takes higher risk positions in the financial markets with the hope of generating outsized returns. Speculators often focus on volatile or unproven assets, anticipating that these assets will increase in value. They may invest in emerging sectors. Penny stocks are options to leverage price movements and potentially amplify their returns. However, this approach carries a high level of risk, as speculative investments can easily lose value, resulting in significant financial losses. It's important for speculators to have a deep understanding of the markets, conduct thorough research, and implement proper risk management strategies to protect their capital. Number 7, the conservative. The conservative approach to investing prioritizes capital preservation and steady, consistent returns over higher risk, higher reward investments. Conservatives typically prefer stable, established companies with a history of profitability and dividend payments. They often invest in large-cap stocks, bonds, or low-cost index funds that track the broader market. This approach allows them to benefit from long-term market growth, while minimizing exposure to speculative or volatile investments. Conservatives often have a low to medium risk tolerance and a preference for diversification, which helps them manage their investment portfolios effectively. So now you know the 7 different types of investors and traders. You might be wondering how they compare in terms of time horizon, risk level, and main focus. Let's take a closer look at these differences. First, let's consider the time horizon, which refers to the length of time that each type of investor or trader is willing to hold their positions. Traders typically have the shortest time horizon, so often buying and selling within a single day or holding positions for a few weeks at most. Investors, on the other hand, have a much longer time horizon, usually holding their investments for several years or even decades. The time horizon of a swing trader or day trader falls somewhere in between that of a trader and an investor, as they usually hold their positions for a few days to a few months. In contrast, buy and hold investors have the longest time horizon, often buying and holding their investments indefinitely. Next, let's discuss risk level, which refers to the amount of volatility and uncertainty that each type of investor or trader is comfortable with. Traders and day traders typically have a higher risk tolerance as they frequently engage in leveraged trading and focus on short-term price fluctuations. On the other hand, investors and conservative investors have a lower risk tolerance and prefer to invest in stable, low volatility assets. Speculators, on the other hand, have a high risk appetite as they intentionally seek out highly volatile and speculative investments in the hopes of generating substantial returns. Finally, let's examine the main focus of each type of investor or trader. Traders and day traders prioritize price action and technical analysis, closely monitoring real-time price movements and using indicators to identify potential trading opportunities. Investors, on the other hand, focus on fundamental analysis, evaluating a company's financial statements, industry position, and growth prospects to determine the intrinsic value of its stock. Swing traders and buy and hold investors fall somewhere in between, as they consider both technical and fundamental factors when making investment decisions. Speculators, on the other hand, primarily focus on high-risk, high-reward investments and are often driven by market sentiment and speculation rather than fundamental values. Conservatives, as the name suggests, prioritize capital preservation and steady returns, often sticking to traditional investment vehicles like blue-chip stocks, bonds, and index funds. Understanding these differences can help investors and traders choose a strategy that aligns with their goals, risk tolerance, and investment horizon. It's important to note that these categories are not mutually exclusive, and many investors may exhibit characteristics of multiple types. For example, some investors may hold a majority of their portfolio in stable, long-term investments, while also allocating a small portion to more speculative assets. Ultimately, the best approach is the one that suits your individual circumstances and financial objectives. Thank you for watching and subscribing to the channel. If you enjoyed the video, please give it a thumbs up. Remember that everyone has different financial situations and goals, so what works for one person may not work for another. Do your research or consult a professional for personalized advice. Stay tuned for more videos that can help you make better financial decisions and achieve your money goals. Before we go, remember to subscribe. I would really appreciate it.